finally have everybody together in the room, which is exciting. Thank you for everyone joining us despite all these tech glitches that we seem to be having. So, without further ado, let's just dive into some of the topics that we have in mind so that we can be mindful of everyone's time. So, I think as we talk about preparing to sell, one of the questions that we wanted to ask Brandon is that, Brandon, as a business tax advisor, what comes to your mind as some examples of realistic valuations or examples? What are the things, the checklist of things that maybe business owners should think about or have ready when they're getting ready to sell their business?
Sure. And can you hear me okay?
Yes.
Nice. That is 5 years at MIT right there. So the things that come to mind for preparing to sell is you need to get your financials in order. So when a lot of small businesses, and we're focusing mostly on small businesses here, we're not looking at public companies or audited companies, something with, structured financials and audited financials and things like that. But for small businesses, you have to clean up your books. So a lot of small business owners bring in personal expenses, like a company car that they use 60% of the time for business. Family members are employees, things like that. So you have to clean up the books and make sure that the expenses are in order, as well as the revenue side, if you haven't already. And the second thing that we often look at are maintenance versus capital expenses. Some of those can negatively influence the actual financials or just sway them in a way that you just don't want them to present that way to the outward buying community. So it's really working with your accountant and making sure that you present the best picture for your business. And the second part of that is being realistic with your price. And we can go into this, but brokers will know the value of your firm, and we currently don't see a lot of practices selling at large multiples these days, unless you're targeted by a private equity firm that's doing a consolidation play. So you have to be realistic that your buying pool is smaller these days, and they're looking for obviously the best value. You're looking for the highest sale value, and so there's got to be some compromise in there. But I think Ed can talk more intelligently on that one too.
I think that was pretty right on, Brandon. Actually,
Nice.
I would add to on the opposite, the financials side of the equation in terms of preparing, the things that can really hurt or improve a valuation when you're preparing to sell in advance is working on reducing the risks associated with a business. If you want to think of what a multiple, an EBITDA multiple or a valuation multiple is, it's really it's a surrogate measure of risk for the company. And that's how they use that, along with all that financials and improving profitability, et cetera, to get to your valuation. And so if you go through de-risking your company, thinking about things as simple as they're simple to say, they're not simple to do, but thinking about your organization, with small, maybe not quite as much in lower middle market, the small businesses tend to have a lot of reliance on the business owner. And so if you can look at your organization to build an organization, right hand, a second person, et cetera, key employees that you can in essence almost go on vacation for a month and the business would still purr along, no problem. That's the business buyers want to see and will pay a larger multiple for that. The other common one, I'd say the most common one is customer concentration issues. It's not uncommon, again, in small businesses to end up with a fairly large customer that's got 30 to 40% counts for 40% of your revenue or more. Those are things you want to work on in advance, because those take years to balance out. And if you can reduce those factors alone, you'll really increase the value of the company by increasing the multiple you'll get.
Yeah, and I would thank you, Ed. And Brandon, I would throw into that too, like reoccurring revenue. And, I don't think that was a hot topic, uh, as hot of a topic 10 years ago, but I think nowadays, if you can show that you have reoccurring revenue instead of just being a transactional company, right? I think that goes a long way to receiving a higher valuation. And that is a great segue into our next topic. And I think this is really the meat of this presentation, is basically how to maximize the sales price. Ed, I'll go to you first. We know that there's a lot of factors that go into the business valuation and receiving the ultimate sales price. Such things as the company's revenue, the profitability, valuation is a starting point, and needs to be done and done well. The sustainability of a company, market trends, growth, and competition. What do you see out of those or any other factors, that you identify that helps a business owner really maximize the ultimate sales price?
Sure. I can tell you one of the more common things and mistakes, I would say, that I see. It's real common in small businesses to manage by minimizing tax liability. For a lot of small business owners, right? They're trying to minimize their tax liability at the end of the year, which means in some companies their financials aren't necessarily as transparent as they could be. They carry what we call personal discretionary expenses on the P&L and the income and the tax returns, and what a lot of people don't realize, the easier a buyer can get financing, SBA or otherwise, and SBA is a real common financing tool for small business buyers, the better the price you're going to get, the better the terms, the better the price. SBA is going to rely on tax returns, and so if you've got tax returns that have a lot of adjustments, a lot of what we call add backs via personal discretionary expenses, that's really they're gonna go out and get a third-party appraisal, and it's not going to come back reflecting the real value of the business unless 3 years or more in advance of selling, you've transitioned into very transparent tax reporting, and then you can get an SBA loan for the full value of the company. So it's really one thing that a lot of people forget to do as they're transitioning towards ready to sell. I would also say the hard, it's kind of common sense, right? But one of the hard things to do is also to time that when things are good, when the trends are upward, when you're having good sales. It's easy to say that, and I get it, but so many times I see it when they've gotten tired, they're ready to retire, and things are starting to maybe not be as strong as they were a couple years ago. But I can tell you it makes a huge difference again in maximizing your price when you got an upward revenue trend, better margins than obviously when you become flat or even have some decline in revenues.
Yeah,
so
go ahead,
Brandon was going to say something.
Yeah, so one follow-up related to SBA is I was looking at acquiring a manufacturing company and going through the financials. This is more of the buying pool, but you have to pay attention to things like grants, SBA loans, COVID loans, things like that, because a company on paper, when I was looking at it for the past 3 years, financials just kept screaming upward on revenue. But when you peel off the layers, you look at, oh, that's a COVID loan for $800,000 that was forgiven. That's an EIDL loan. Oh, they borrowed that from a family member. And some of these things don't look as rosy as you think they do. And that's really inherent to personally run businesses with 1 or 2 business owners, where you can really look into stuff and find little, nuggets. And I would also say on maximizing your sales price, one perfect example is, well, you have to be true to what kind of industry you're in. And the best example is Peloton most recently. And I pulled this from a class I had at USC last year. from Deloitte, but Peloton was trying to pitch themselves as a network orchestrator and a technology center where their revenue was really coming from subscriptions. But when you dug into the financials, you found out that 80% of their revenue came from manufacturing bikes, which is a asset builder. And this was back a few years ago during COVID. And so their stock price wasn't justified by the way they were trying to present themselves. Ever since that point, they've sold off or divested their manufacturing division and they've focused purely on technology and network orchestration. But it shows that the acceleration and decline in value really plays into what kind of industry you are in and how you present yourself, and just make sure that you are putting that best foot forward and being realistic.
Now, how often do you guys think that companies are not realistic in how they present themselves? Like what percentage would you say, or how often does that happen?
Well, I guess I tend to think of the realistic in terms of what their company's worth, and being objective. And I surprisingly find more small business owners to be relatively objective about that and listen when you're presenting them with kind of facts of their industry multiples, et cetera, et cetera. But I would say there's still 20% that I deal with that just look at and you put an appraisal or evaluation in front of them and just don't feel like they want more. And I can tell you there's lots of studies showing the number one reason businesses don't sell, small businesses, is because of the price, because they've basically overreached, and people that are looking, that think sellers that are serious are asking their true asking price. So they just they'll see their relationship to the earnings and just never inquire or follow through with expression of interest.
Yeah, I agree with Ed also, and I would add it's Angela, you asked like how many are not realistic. I would say if there's a good team developed to go through this process, they're gonna, just from talking to the team and talking to the experts and the advisors, they're gonna get realistic very quickly, right? Because starting with the valuation, that will identify those extra expenses that are personal maybe and not business related, that it'll come out, it'll scream out right away, that both Ed and Brandon mentioned. And so that's part of this whole process, and why a team is generally pulled in to do this and help a business owner go through the process, because the company needs to be structured correctly and built for sale, and then then everything flows correctly, and you get the hopefully the better multiples and everything else, because you are by the end, with the accountant and with the broker and every other advisor along the way, you get everything cleaned up, and that allows the business to really shine versus their competition that doesn't have a team involved and is just trying to wing it. And so I think having the team in place really helps in this whole process. Brandon, you did mention something the other day when we were talking about this, and I wanted you to briefly discuss what you're talking about when you said that experience with shaping historical figures for a sale and projecting them out for a purchase or a new shareholder, like how to grab the historical figures and project them out. Could you explain that to us a little bit?
Sure. So when you're on a private sale, when you're not selling to a fellow employee, or a close friend or things like that, you're going to be highly scrutinized on your historical figures. And then they're also going to project out in a pro forma how the business is going to perform under the new ownership, and try to make sure that they attain the highest ROI on their investment. And so one sale I was involved working with Goldman Sachs and others, where the firm was projecting, well, we first had to isolate some of the items that were related to the owner first, like profit sharing or salary, and any expenses that were innately part of them. You remove those, and then you try to project out the expenses historically over like inflationary measures. And that's the most common, where it grows like 2 to 3% per year. But there are anomalies like insurance. Insurance climbed like 25% over the past year. You have to adjust for that. Supplies adjusted a little bit higher than others. But the buyer will be on one end of the spectrum saying, no, I negotiated those and those costs decreased, and therefore you'll gain better efficiencies acquiring this business and putting it in your portfolio, so your expenses should decrease even further. You can use that angle to justify higher ROI. And so it's going back on each of those metrics, on supplies, on rent, on salaries, on things like that, where it's not a quick projection, a straight line projection. It needs to reflect the new ownership and the current economic environment that you're in. All right. And that's not always difficult, but it was that negotiation was a fun one, because it was back and forth among major investment arms. And it ultimately just, the two owners did a handshake deal and came to a price, and that was it. Didn't matter. All the financials were out the door at that point, which was kind of funny in its own right. But
well, Brandon, before I let you go, I have one more question to you, kind of in line with what with the last topic is. Can you talk about some of the different structures that businesses can do prior to sale, and the tax implications of that, and how goodwill plays into sales, especially among like professional practice sales?
Sure. So your business is typically, we're talking about LLCs, S corps, and C corps. Rarely you see a sole prop being sold, but we're going to stick with those three structures. So LLCs and S corps are pass-throughs. C corp is its own independent entity. And so you have to structure it based on what kind of entity you're in. And we have seen some people carve out their business depending on the sale. Like if they're very charitable, they may carve out a portion of their company to a CRT, which is a charitable remainder trust. And that enables them to avoid the cap gain on that portion carved out to a CRT, but they need to find a charity that'll accept that portion and provide them an annuity for the rest of their life, essentially, as an income stream. We haven't seen that in a small company. We have seen that in stock of larger companies, how the owner of that stock would gift it to a charity and create a CRT around it. So there is that type of structure. Otherwise, you're looking at a sale of that entity to a buyer. And when you look at trying to carve out the sale and trying to divide it into certain categories, the lowest hanging fruit is you assign it to assets like your car or equipment within the corporation and things like that, and any type of covenant. That's really small amounts. And you look at how much depreciation you have on the books and what the value is of those assets on the books, and also fair market value to attain a price. And you kind of work the numbers to make sure it's the best amount allocated to that. Then the second aspect is goodwill. Goodwill, you have corporate and personal goodwill. And as a sole business owner, you need to, you obviously have a lot of personal aspects to that company. And it's structuring it so that if you have a C corp, you want as much personal goodwill as you can justify, as that is treated in terms of a long-term capital gain. But if it's more shifted over to corporate goodwill, then it suddenly becomes subject to double taxation through a dividend structure on the C corp. Pass-through entities, that's a different story. Corporate, personal goodwill, that just flows through. It doesn't quite matter. But on a C corp, there's a lot of attention put on how you structure that goodwill. And we also look at court cases. The most common is Howard versus US and Norwalk versus Commissioner. Those are two that come to mind, where the employee who was the owner, the sole owners, made a non-compete clause with themselves, and they kind of carved themselves out of the corporation. That's not good for trying to justify that you have personal goodwill in that corporation when you have a non-compete clause against yourself. The ones to look for where you do have a lot of personal relationships and you strive for that personal goodwill are like Martin Ice Cream Company and Boss or Bros Trucking versus Commissioner. Those are good cases to look at where you're able to carve out a lot of personal goodwill and get that long-term cap gain treatment.
Thank you very much. A lot of nuggets in there. We're going to shift gears a little bit and talk to Ed about finding the right buyer. You know, in talking to Ed and Brandon before this webinar, you know, both of them expressed to us that, you know, every deal is different, right? And the way that you go at the whole process and everything that you do prior to that is going to be key to that individual seller or buyer. And so we wanted Ed to talk a little bit about how he goes about sourcing buyers. And, you know, very commonly we hear from business owners that really they want either the maximum price or the greatest price they can get at the end, or they want to find a buyer that is the right buyer. You know, and that's someone that they're really comfortable with, you know, that would, you know, carry on their traditions and take care of their clients. But Ed, you're the expert on this, so I'll let you take it away on sourcing buyers.
Thanks, Kevin. Sure. Yeah, so I guess, you know, typically we tend to put buyers into a couple different buckets, if you will. From the first one people typically think of are strategic, or you might call them industry buyers, that they're already in that business. So they, you know, supposedly could have some synergies with acquiring that business. It might have more value to them because they're in the industry. That's one group. The second group, financial buyers, usually we typically think of, Brandon mentioned them earlier, private equity groups. In this one, they can also be the right buyer because they might be doing roll-ups. Again, as Brandon mentioned, they've already got a portfolio with other businesses similar to the one that you're selling, and it makes it a strategic buy for them, even though it's more from a financial perspective. And the last one that people, oddly enough, as many times as the other groups, particularly in small businesses, is the high net worth buyer. Now, for those folks, the reason they can be the right buyer is because they're in essence acquiring a company to get all that goodwill that a company has built over the year, the customers, the systems, the employees, the processes, right? All those things, the recipe that goes into making a business successful. So a lot of times, I don't know how many times I've had a business owner tell me, go, well, I need to sell this to a strategic buyer. And I agree, you got to include those people in the equation when you're sourcing buyers. But I tell them, you just really don't know. The buyer could look like any one of those three: strategic, financial, high net worth. And the way you go about it's different. On the financial, the private equity, strategic, there's ways you can go out and locate those folks through various databases or other means, where you want to come up with a buyer list as part of your selling process, preparing to sell. So you are reaching out, you're proactively reaching out to those specific buyers that you know are interested in the industry that the business is in. And then there are I wouldn't say they're not proactive, but they're more kind of broad reaching, getting the word out there through various for sale sites where the buyers are coming to you. These tend to be more the high net worth, but you'll find even the strategic, they're all having tough time sourcing deals. They're looking at 50 deals to find a business that they might ultimately transact on. So those three, and there's different approaches for each one of them that a good broker or somebody, M&A advisor, would help you locate and approach all of them.
Wow, 50 deals just to find one. It's like quite the hunting.
Yes, it is. That's,
quite
yeah,
the
that's
shopping
correct.
thing. Yeah.
Yeah, and that's why
Wow.
I tell sellers when they do have a good business, they're in hot demand. I can tell you recently, a good manufacturing business. The average time to sell, typically, statistically speaking, is like 9 months. But I can tell you, we're selling manufacturing and distributions. If it's a good, strong business, 3 to 4 months is not unrealistic right now.
Wow. 3 to 4
Yeah.
months. That seems
Yeah.
very quick.
That's good. That's fast, very fast. But the demand is there to facilitate that.
So now, is that the
Eh,
industry that you are seeing as kind of like the hottest industry right now?
For me, it is. I don't, again, I don't specialize in high tech. I do high tech manufacturing, but software. There's a lot of industries I'm not specializing in that I couldn't speak to, but I just know, as a matter of fact, that manufacturing and distribution, again, with a good business, a good track record, strong books and records, they're high in demand, and there are far more buyers out there looking to source those deals.
Yeah,
That's
and
really good to hear.
Brandon mentioned earlier too that private equity is an increasing buyer in the marketplace, and I think that there is an explosion of money, idle money sitting in private equity right now, and so that just by definition they have to go out and find acquisitions. They have to go out and basically build a consolidated company, and they might do it in a certain industry and buy one and then try and add on to it and basically just build it up to eventually exit, and all along cleaning up the books and doing all the proper things. So I think there's a lot of money driving that side of the market, but there are industries that they really love to go into, and there are industries that generally they will just leave alone because it doesn't interest them. But from my standpoint, the biggest thing I think they look for is free cash flow, right? Because then they take less risk if they're cash flowing along the way, while they're building up, a much larger business that they're hoping to exit, maybe to a public company, as the end game. Brandon, do you have anything to add to that?
Yeah, the private equity firms that we deal with or have dealt with in the past, usually there's a timeline on their fund, which is their exit. They're looking for 5 to 7 years, typically 10-year max. So that is one consideration for a seller of a company, especially an owner who's built up their company for 40 years. You may get a good price, but they're gonna roll it into a larger pool and then divest it again and again. Actually, I've seen a few of those companies come back to the owner at a discounted price after they sold it, because the private equity kind of got into something over their head. And now with rising interest rates, it is much harder to fund deals right now, because a lot of those high net worth individuals can put their money into a 5% bond, and there's very little risk. So they are, at least the people I know in that industry, they are struggling to fund a lot of their latest deals. So that money seems to be drying up right now, which is not great news for small business owners.
Right. For sellers, yes. Well, thank you so much. Angela, you have something to add?
Oh, well, I was just going to say, we often inform, our business owner clients that a business sale is not always complete just because the money has changed hands. And so I was just wondering, what are some of the post-sale activities that business owners should consider after the sale?
And maybe Ed
Are
go
there
first.
any?
Sure. Yeah, I'm happy. Like, I can certainly, as a business broker, I wouldn't call it quite my finish line, but it's generally where the bulk of my involvement. But I do know from the terms of agreements for owners, things they need to anticipate, expect, and be prepared to consider post-sale are terms related to consulting, post-acquisition consulting employment agreements. And again, this goes back to thinking, maybe planning ahead, that look, it might take you 6 months to 12 months to sell your business, and you're not just going to walk away the day after closing. You might be expected to stick around. So that's an important post-sale involvement. Sometimes there are, depending on the business, earn-out notes, which is kind of like a royalty, if you want to simplify it, an earn-out note where an owner and a buyer feels they need to leverage some of that owner's goodwill in the business and keep them incentivized for the business to continue to be successful. So there might be a consulting employment attached with an earn-out note to be incentivized for the business to continue to do well. A non-compete, right? There's going to be a 3 to 5 year, typically a 5-year non-compete, which, if you're retiring, that's non-issue. But need to think about those things depending on what your goals are post-sale, and to plan for all of those. So I can tell you those are the things that from a transaction deal structure standpoint that owners need to be thinking about after the sale.
Yes, I would say it is very common for the purchaser to want the owner to stay on for a certain time after the sale. And
Yes.
that just ensures that they have a better transition, and it looks a little bit more seamless when they're still there for continuity's sakes. And that might be 5 years, and in most cases, the owner is pretty well compensated for staying on also. So he or she has an incentive to be there as well, so that everybody wins. Brandon, could you give us some examples of some good some good examples and bad examples of transactions, and how that fits into the whole post-sale considerations?
Yeah, so so for our clients who have sold their businesses, as Ed mentioned, you need to make sure that employment contract, if you're being retained, you understand it, because you do release control. That's probably the hardest thing for small business owners to do when they take a back seat after they sell, and understanding the compensation scheme, and also not, you're shifting to a pure W-2 employee after that. So, you can no longer write off your personal cell phone. You don't have that choice. There are certain things that kind of take small business owners by surprise if they are retained by the new owner. And there are some structures like an ESOP, sell your business to your employees. That's incredibly rare. I think there are only like less than 10,000 in the US. We have one client going through one right now. But that's where you step away. You get some great favorable tax treatment on the sale, eliminate and defer cap gains, but you have to step away, which is hard. And you also lock your money up into certain assets after the period. But it's all part of your plan on what you want to do with your business. Do you want to stay involved or not? And you just have to come to grips on your life after you sell your company, and be realistic about what your role will be.
Yeah, I was going to say a lot of I always joke with owners that as a business owner, it's hard to be employable once you've been a business owner and an entrepreneur for 15, 20 years. We generally don't make great employees. So you got to really be committed to that and understand what you are getting into, because it's not easy. It's just like the life change of going from, a business every morning and having that purpose to, well, what am I going to do with myself today, right? And those are the things that people other than myself and Brandon would typically help a person with that transition part of it. But I was also just going to comment that even on the private equity side, there's a lot of private equity that really are very interested in keeping the owner more than just even with some continued equity in the business. So for owners that are ready to just kind of do their quick time and get out, they can still do private equity, no problem. But there are a lot of private equity groups that like to do an equity share arrangement, keep them with 10%, 20%, and have the so-called second bite at the apple within 3 to 5 years. And that can be a great win-win for a lot of owners that are kind of ready to start exiting from some of their equity, but maybe still aren't quite ready to retire and go golfing or fishing.
That's a great point.
Right.
So thank you very much to our two panelists, Brandon Holm and Ed Fixon. We really appreciate your knowledge. And the next section we're going to go into is the Q&A session, and Angela is going to lead that.
Yeah, so we have a question from the audience, and the question is rapid operational cost cutting to increase EBITDA a red flag in a sale? And if it does it appear as less of a red flag if the cost cutting takes place a year prior?
Yes.
So that's probably a Brandon question.
Yeah, Brandon, you go ahead, and I can comment as well.
Okay.
Yeah, typically any buyer is going to not ask for 1 year. They're going to ask for 3 to 5 years of financials. So a sudden cut in 1 year doesn't necessarily adjust a sales price, but it would influence it a bit, I would say. And then
Does it
you
look
also
like a red flag if you're a buyer?
well, when I
Like,
look
oh,
at
this is bad news. Don't touch this thing.
no, it's not bad news, but it's more like if you're buying a business based on the trajectory of revenue and decreasing expenses or something like that, having a one-off event in 1 year, it just kind of makes you think like, okay, if you could decrease your expenses all those years and you suddenly did it last year, why did you wait all those years to do it? And then you kind of get all the questions going to follow up. So it does, any anomalies, it's gonna highlight it, when you expect out any expenses or revenue, and it's gonna make you ask questions. Simple as that. You're trying to normalize the expenses, not try to vary it.
Yeah, I totally I agree. I think highlight's a good word. It's not that it's a bad thing necessarily, obviously, right? That's a good thing. If nothing else, hopefully it'll show that, I think that the challenge is making the story that it's a sustainable level of operating expenses, et cetera, because that's what a buyer's going to want to know. That's why, as Brandon said, they look at 3 to 5 years. They're going to want to, you're going to have to vet out how that's a sustainable level. And obviously those kind of cuts can't, there's a limitation obviously to that, whereas growing the top line is probably the more preferred. And even in that case, I have a business right now that they all of a sudden took off in 2023 and they wanted to sell. And I had to have that realistic discussion that, the fact your revenues just went up 75% there's gonna be lots of questions about how sustainable and why is that sustainable, et cetera. So all of those things are going to get really closely vetted by, there's no greater fool theory when it comes to buyers and buying the size of businesses we're talking about. They're gonna vet these issues very, very closely and make you prove it's sustainable.
Yes, and I would say, unless there's a circumstance where the industry is blowing up, right? And at that time, maybe even a competitor comes in there and takes them out at even a higher price, right? Just because they want a bigger chunk of the market share in their area, which is a possibility. Probably doesn't happen all that often. But Ed, our last webinar, we spoke about along the stages, the 5 stages of the sale. We talked about the timeline and readiness, and I know that's the one question I wanted to put in front of you too. Is like, how often are the sellers unrealistic on the timeline? And I know there's some companies out there that say that they can sell your company within 150 days. Is that reasonable, or is it typically a much longer process to get everything set up?
Yeah, you can't. I wouldn't tell somebody that I can sell their business. I just think that's even with a really good, I believe that in certain markets, if I knew enough about the business, there might be instances where I would tell them that I think that's feasible. In general, I wouldn't count on that. In general, I think you just have, I've had one of the best businesses we ever sold. Actually, the deal died twice before we got to a third buyer and finally closed it in month 14, believe it or not, because we spent so much time with buyers getting to within weeks in some cases of closing, and a variety of circumstances. So, and that was and I'm talking about a really good, profitable, growing business. So those circumstances, it's like everything. It depends. 150 days, I would generally say, look, 6 to 12 months is a reasonable range to just think about. Could be shorter, it could be longer, but on average, that's a reasonable range to think about.
Yeah, and that's if they're not trying to change the organization and like recraft it. If they need to grow it, it probably could be a 3 to 5 year situation.
Yeah, there's in my world of again, at the low end of the lower middle market small businesses, they're usually ready to sell or retire, and they don't often take the time to reposition the business like they should. Some do. I'm not saying all, but many, it's just a personal decision that they've come to. And they haven't allowed for that 3 to 5 year time to really do the proper to do exit planning if they need that. A lot of entrepreneurs are technicians who are great at doing what they do, but for example, they're not good at marketing and business development, right? And they're so lacking on that side of it. That's why they end up with customer concentration, et cetera. They don't look to their weaknesses, the things they can't do, and we tend to want to, as entrepreneurs, do it all ourselves, and small business owners, which is a problem.
Yes.
Right.
Thank you, Ed. And Brandon, any last comments really about, something that you can think would be the most important part in this whole valuation? I have a feeling you're going to say the books, but it is such an important part in having the books in order when buyers are coming in, and what they see first up, they probably look at that before they ever engage to speak with you or learn a little bit about the background of the business or anything else. But maybe you can talk a little bit more about that as well.
Well, Kevin, just be mindful. Our time is up in like 2 minutes.
Okay.
It can be, but also it could be your position in the market or in the community. And you could just have a really nice location that just attracts multiples of business, and someone's going to give you a higher valuation because of it. So we've been surprised in the past. I mean, for a lot of our dental and medical businesses that are smaller, they struggle to find buyers. No one's really buying them right now. But if you have a really good location with a lot of clientele, then you'll maybe get lucky, get a private equity firm come in, and they'll give you 6-8x, which is tremendous, versus just giving it to one of your new doctors at,
right.
$10,000-$20,000 max, so it totally, these, if you have it's like anything, if you get a good quality asset and you build it as such, you'll get a good value for it. But yeah, you never know who's going to come down the road.
Yes, and actually a great team is I think a key to making this a transaction happen and making you look attractive to other potential buyers. Well, we want to thank both of the panelists. We really appreciate you being here. This was our second webinar. We have another exciting one coming up in 2 weeks. Angela, do you want to introduce that briefly?
So in 2 weeks, so we have 2 more webinars as part of our summer webinar series. The next one is on June 27th, and then another one on July 11th. They are both going to be covering multi-generational wealth transfer within your family, as well as charitable gifting strategies, which is an area that is near and dear to my heart, because I think it's important for families who are more well-to-do to give back to the community. So we'll be talking a little bit more about that, and we'll have some great panelists as well. We have a couple estate planning attorneys, as well as somebody from the Torrance Memorial Hospital Foundation. So stay tuned for more information on the next two webinars. We hope that you will join us, and thank you so much again to Ed and Brandon. Until next time.
Thank you.
Thank you. Okay.
Thank you.
Bye, everybody.